Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hello? Yeah, good. Yeah, hello everyone. I'm glad that the rain didn't stop you, but the techniques almost stopped me. Where is it? Yeah, I do need this one because I'm going to draw something during the process, so hopefully, what is the problem? Okay, let me see. Okay. All right, so we have a lot to cover. As you can see from the screen, we have 3 chapters. Hopefully, you have reviewed the slides a little bit. And that's about chapter 16, chapter 18, and chapter 21. We are going to discuss the presentation of financial statements. Financial statements you are familiar with, are you? Yes, you heard a lot about that, right? So that will be something we probably can run relatively quick, right? And we have accounting policies and other disclosures. Have you heard about accounting policy? Accounting estimates? You absolutely heard about it, but we are going to discuss a little bit. All right, see how much memory you have or how much knowledge you have learned. All right, then we will have the last chapter, related party transaction disclosure. So related party transaction disclosure, it could be a little bit tricky. That's why I certainly need to draw a little picture for you so you might be able to follow. Then you will see how do we make judgment on those transactions. Shall we disclose, shall we not? All right, so these chapters. Last lecture, we discussed about the whole background information, the regulatory environment. That's towards the whole accounting standard as an accountant, what you are going to face from the regulatory actions or the regulatory bodies, right? That's what we have learned. That's kind of more macro. So this topic, we are going to talk more about specifically regarding to the reporting. All right. So we will have annual reporting requirements. What are they? Then we are going to talk about the general purpose financial statements. And these general purpose financial statements, normally for the public firms, you need to prepare them, right? Because we have the common users. They are going to use this data, this information, and you can't really, they don't have the special request that they can get some information adapted to them. So this statement is produced for the general purpose, for the common use. That's the general purpose financial statements. We're going to discuss some features of that, and we are going to have the notes. So first of all, we heard about financial statements, right? Financial statements. What financial statements have we learned? Oh, we are aware of. Balance sheet, yeah. Financial position, oh yeah, good. Income statement, yeah. Changes in equity, good. Cash flow, yeah. Are they all? Yeah, so far I guess you have learned this much, right? Normally we have these 4 statements, right? And these 4 statements, and you may have one more, but which is called consolidated account, if needed. If that's a group, if this company is identified as a parent of the group, this company needs to prepare the consolidated financial statements. All right, so if that's involved, you will have another set, which is called the consolidated statements. All right, consolidated accounts. So that's the financial statements we have learned. But here we have a word called annual reporting. Annual reports. Do you know what's the difference between the annual reports and financial statements? We talk about the 4 financial statements, right? If applicable, consolidated as well, but we'll just talk the 4 fundamental ones, all right? Are they part of the annual report, or is the annual report part of the statements? Well, 4 statements we have normally, if we prepare the balance sheet, the financial position one, right? We probably have 2-3 pages purely for the tables. You look at the items, assets, liability, right? Then equity, then that's the financial statements, the position, right? Balance sheet. The income statement, probably around 2 pages. And sometimes the cash flow 2-3 pages. Then we have the equity in change, the change in equity, probably 1 page, right? Or maybe a little bit longer, shorter. That 4 statements only part of the annual report. So annual report, if you go to look at any company's annual report, it could be 70 pages, 80 pages, 100 pages, or some may involve 200 pages. That's possible. Okay, you are going to do some annual report analysis for this group assignment later on. Yeah, but first of all, we need to understand what is the annual report, what is included, all right, what are included, all right? So that's the annual report. Financial statements is only part of financial report. Financial report is only one component of annual report. Is that clear? So not only financial report needs to be reported annually, some other information should be included in the annual report as well. So you need to send your annual report to your shareholder every year. Okay, annually. That's the annual report. We are going to discuss more in a minute. All right. So like I said, financial statement could be just a couple of tables, all right, couple of pages. But if you really look at the financial statements, it normally looks like much longer than that. Except for the tables we normally prepare for, you will also see some notes. The notes are very important because they help the users to understand the message from the line item from those tables. So notes is also important. We are going to discuss a little bit for that. Then we will see in parts of notes, one thing you have to disclose, that's the accounting policy. Okay? You have to disclose the accounting policy and accounting estimates. You might have a little bit of confusion about accounting policies and accounting estimates. Normally people do find them a little bit confusing. I'll show you the difference, okay? And if you have issues, like last year you filed your financial reports, financial annual reports, and financial statements in there, and you got some issues. Either intentionally, unintentionally, you do have some issues. How shall we deal with them? Okay, that's what we are going to discuss. And we are going to discuss some materiality principle, so you will see what is that. And the last 2 things we discussed is the events occurring after the reporting period. That's one thing. So we do understand each financial statements, financial reports. When we are preparing for them, there is a period we prepare for. All right? Normally 1 year. If we are preparing annual report, that's for 1 year, right? That's for 1 year. Then how about, but you know, when we are doing that, we need to report the financial position. Let's say for the whole calendar year, from the 1st January to the 31st December. That's for the whole year, right? So we need to report the asset at that point in time. And we need to prepare the income statement for that period. How about something really important happened after that date? Because you know, when we prepare the statement until a point in time, but we still need time to finalize them because the directors need to do something and the auditor need to do something. Now, eventually, the reports are ready for users, right? But before they are ready for the users, it normally takes maybe 3 months. So your end of the period is the 31st December. However, you probably can issue that on the 1st of March or the 30th of March, 31st of March. Okay, 3 months or 2 months, right? How about something really important happened during that period? If something really happened during that period, are they important? Are they going to influence the user's decision? If so, you need to report them. You need to disclose them in a way. How do we make judgment? Shall we adjust any number or shall we just disclose the event? That's about the events occurring after the reporting period. Clear? So we need to make judgment, and we have the guidance to follow. So that's about the events occurring after reporting period, but before you issue the reports. All right? And another thing is called related party. Related party transaction, no matter how big or small, in nature, they are important. Why they are important? If company is legal entity, they can be treated as a person, right? They are granted a life from the law, right? By the law, right? So that's the legal entity, so that becomes the legal person. Now, if they have the parent, it could be a parent company, right? Just like you and your parents, okay? If you and your parents have transactions, and your parents really want to give you some fortune and make you look good so that you can marry some really nice guy or girl, whatsoever, but it doesn't show your ability of earning money. Suppose that's the case, all right? So in that case, we really want to see how much money you can earn, how much bread you can bring home, right? But if your parents give you a lot of money, you need to disclose. Otherwise, how about the other party can find out, right? That information is not useful for anybody else who wants to choose you, right? So they need that information. And if you and your parents have your parents may say, okay, I will not directly give you money. I may just make a deal with you. So they may have something, okay, suppose they have 10 houses, okay, then you purchase one from them. That house is worth 5 million, but they only ask for 1 million from you, then you immediately make a fortune of 4 million, right? Shall we disclose? Of course, related party transaction in nature is important, because otherwise people may not understanding what's going on and what's the real ability of this reporting entity. Okay, so that's something we are going to discuss. But how do we make judgment on a related party? How can I say, okay, your parents is your related party? Yes, certainly they are. And how about some others? All your parents has a company, and that company and your company, are they related parties? So this part, we mainly discuss how do we identify the related parties. Okay, we probably won't discuss much about transaction, but in the later half of the whole study, we are going to discuss the group, the consolidated parts. Then any transactions, how do we account for them, what amount we should recognize, we will do that in the later part. So at this stage, you just need to understand who are the related parties. All right? Okay, so here are the first topic, annual reporting requirement. Like I said, financial reports, part of the annual reports, okay? Except for financial reports, we probably only know the financial reports part. And our understanding of financial reports mainly from financial statements, right? But at least we are aware of that. The financial report is not only composed of financial statements, at least we have notes, right? So now, at this stage, you know the annual report includes financial report. Financial report is not limited to only financial statements, okay? So we have financial report. Then we'll have the director report. Another one is the auditor report. So 3 of them together compose of the whole the whole annual report. So each time when you see the annual report, it must have the 3 components because that's regulated, okay? That's compulsory components that an annual report should include, all right? Financial report, director's report, and auditor's report, all right? We're not going to discuss much on the auditor reports because you're going to have another course called auditing and insurance, right? So you will learn more from that. And in this course, we are having this financial report. Financial report not only include financial statement, as I mentioned, it also includes notes. It also includes another thing you probably are not aware of yet. That is the director's declaration. The directors need to make a declaration. On the day director makes the declaration, the financial reports are ready to be issued. Okay, without the declaration, the financial reports can't be issued. Is that okay? So that's just the requirement. And the financial statement, like we mentioned, we have the four elementary financial statements. So balance sheet, income statements, the cash flow, the changes in equity, right? If consolidated accounts involved, you need to do that as well, all right? And the notes to financial statements are very important. They are much longer than the space that the financial statements contain. Because you need, for each line item, basically they will have a note. Corresponding to the line item, you will see the note number. So that one, because without that note, you don't really know how this reporting entity prepared for the statement to get that items over there. You don't really understand the numbers, you don't know the policies, you don't know what kind of estimates they have made. So you need the notes, all right? The notes must contain all information, need to ensure the financial reports provide a true and fair view of the financial position and performance. So, true and fair. How can I say that's true and fair? You know, you perhaps feel accounting is really everything regulated, everything standardized. You don't have much judgment. But you were wrong if you thought so. If you look at what we are learning from this lecture, you will feel we need to make a lot of judgments every day as an accountant. Even we have clear standards, it could be interpreted differently. And some occurring events, it involves your judgment to make decision. How shall I report? How shall I include that in the statements, in the reports? Okay, so those are all the judgments you need to make. Then how can I make sure that will be true and fair? Right? Whenever it involves judgment, it could be subjective, right? But we want them to be true and fair. To what extent I can say, okay, this statement, this report really, truly, fairly reflecting everything happening in the company. Sorry. Oh, upside down. Sorry about that. Oh, okay. Now it's much better. Sorry about that. You're laughing at me. Okay, I'm fine. So how can we say the statements are truly, fairly reflecting everything? As long as we are fully complying with IFRS and WAS, then we are fine. Okay? We say when we are complying with the IFRS and WAS, then we are fine. Okay? We would say this is fairly, truly reflecting everything. No matter how much you agree or disagree with the standards, you need to comply with them. As long as we are complying with them, this statement is fully, truly reflecting the business transaction. That's it. Okay? Director's declaration, they need to make the notes like the following. Then the reports can be issued. What they need to say, they need to have a statement of whether the financial statements and notes are in accordance with the Corporation Act and accounting standards. Okay, then basically they are saying we are truly, fairly reflecting this company. We present a true and fair view of this company's financial position and performance. Okay, they need to make such declaration. Why we need that? From the user's point of view, why we need them? Why we need them to declare that? We want to take them accountable, okay, because they understand the business. If you say the business is fun and we are doing fun and also I report it in the way it should be, then you are accountable for the words you said, okay? So that's why this is required. And a statement of compliance with IFRS as well. A statement of whether in the director's opinion there are reasonable grounds to believe the company is solvent, which means they are still able to pay their due debts. Okay? So they need to declare such things before their financial statement can be issued. And on the day of the declaration issued, the financial reports can be publicly issued, ready to be issued. All right? So that part is from financial report. Clear? Financial reports includes statements, notes, and declaration. Okay, director's declaration. So here is another component of the annual report, director's report. Okay, director's report. So director's report could be comprehensive. It could include everything else from everything else rather than the financial reports. Okay, regarding the business, regarding the management, regarding the strategy, okay, everything regarding that, almost. So they have the general information should be included. One is a review of operation and results. So, and also they will have details of significant changes during the year. If you raise a lot of money during the year, you need to say that in your director's report as well. If you open some new company, new branches, if you enter some new markets, those are all important things you need to report. So those information would be relevant to the user. They can decide how to allocate their funds, whether they want to invest or they may want to withdraw. Okay? Can the shareholder withdraw their money? In a way, there is a second market, right? They can, the secondary market, so they can sell their shares to somebody else. So they can't directly ask the money to pay back, but they can sell the shares from the secondary market, right? And the likely future development, yes, those are required, but how likely the company can disclose them is very subjective. It's very subjective. Because if you disclose the likely development, not only the users, the shareholders see that. Your competitors may also see that, right? So you will see how, yes, of course, a clearer picture would be better for the users. But you may also want to see how much the business want to maintain, want to retain the information. They don't want to, right? So yes, that's about the, another one is the environmental regulation. Nowadays, you may see a lot of the environmental regulations, related issues. They will disclose in their the director's report part, okay? And they may have specific information regarding their dividends, directors. So if you check their annual reports, you will see all the directors' information, so their gender and their other positions in other companies, or background, educational background, working experience, so you will see a lot regarding that. And if you have any options, indemnities, and issued shares, you all need to disclose. Anyway, this part is a little bit subject. It's compulsory, you need to disclose, but it largely depends on what the directors want to discuss, right? So that's the director's report. And then we have the auditor's report. They must form an opinion as to whether the company's financial reports are in accordance with the IFRS and WS. They need to say so, all right? And they will see whether they are able to get access to all the records and information, whether or not the company has kept a good records of all those information, then they can address their opinion. Then we will have the auditor's report. Okay, here I will have some quizzes for you. I suppose you all have downloaded the Polar Bear. Yes, this is something interesting. The university has purchased this one before, then eventually they dropped this purchase, then they will get it back soon. So I decided to stick with this small app. It's very useful, very interesting. And currently, only your first 25 responses will be received. So be quick. Okay, so you know how to do that? So either you use this, if you have downloaded, you may have your name on this app. You can do the web voting, or you can text to a number I'll give you here. Okay? Okay, so this is just a trial. See if it works. You can either text this contacts, I suppose we are all, to this number just as a text message. It doesn't cost you anything, I think. Yes, and yeah, once you join, you can just type A, B, or B, or C, or D. And or you can respond at this. The username for this, for Alvare in this course is accountaholics. All right. So let me know your opinion for accounting. How do you like accounting? I'll see whether it's working. You can find this, and this is the username. Or you simply text this to this number. Then let me know how do you like accounting. I hope we can be a little bit quicker. Yes? You can't do anything? Yeah, let me see. It should be, I tried at home, I will see. I'll just randomly see. Oh, it's full. Also, now you can respond, but why the results is not out? So several of you have responded, but why I can't see the result yet? Let me see. So now I believe a couple of you Let's see if you can do this one. If this one not showing well. Okay. I guess you did participate. Anyway, I hope you all choose the. So since I can't see the results, I assume all of you have chosen accounting to be extremely exciting. I believe you have done so. So that's good to now see your results, right? Okay. So see if this one can be working. How many of you have text or send your response? Once you send your response, this will be anonymous. That's why I want to use this one, okay? So you don't worry about your answers, whether that's right or wrong. So can you text or? So you did do something, right? But the results didn't show, right? All right, thanks. I will see what's the issues. Can you see if you can work on that now? Okay, all good now. Oh, all right. Okay, so the financial statement of the entity are authorized for issue on which one? Just quick examination for your memory. See how much you can get from the lecture. So the financial statements of the entity are authorized to be issued on the day the director's declaration is signed, 30th June each year, the last day of financial year, the day the auditor's report is signed. So which one? Majority is the first one. Yes, I repeatedly told you on the day the director's declaration is signed, the reports are ready to be issued, right? That's not the last day, that's not the end of the period. All right, that's not that day. At that day, we identify the position, the financial position of the firm. We identify the firm, how well the firm has performed. But that's not the day about the statement to be issued. Okay, the day to be issued is only when the directors declare, okay, their accountability actually, or their duties. Okay, regarding the financial reports, other than what we have discussed, there could be other reports, like the concise financial report or the half-year financial reports. The concise financial reports, they're still there, still in the standards, but basically it doesn't have the need anymore, because previously, when we don't have emails, when we don't have electronic versions, we always need to send them to the shareholders. And the whole 100 pages, that's a visible paper, and also delivery costs, and also the shareholder will be bothered a lot, right? But now we have the electronic versions. Basically, it doesn't matter much. But if you are about to prepare any concise financial reports, you need to see the things that should be disclosed at least. All right? They have some minimum requirement for the disclosure. Some firms could be subject to the half-year annual report, half-year financial reports, and the whole thing is called the semi-annual report, right? So there are some interim financial reporting requirements that will be regulated by a specific standard. It also needs to include director and auditor's report for the whole half-year financial reports. All right. Yeah, then the general purpose financial statements. So it needs to have the following 8 features. The following 8 features. I believe you have learned most of them already in the prerequisite course. Like the fair presentation. I also repeated, how can we say that's a fair presentation? Fair representation, that's the compliance, right? It needs to comply with the FRS, the WS, right? So the accounting standards in Australia. So that's the fair presentation and compliance. Going concern, what is going concern? The company is long live the king. The company will survive forever, right? Suppose, no company can survive forever, but we have to make an assumption. Otherwise, like the asset, this year depreciation, I would say 10% of the asset, but actually next year the company goes bankruptcy. But we have to make the assumption this is going concern. All right, there is a going concern condition. Otherwise, we can't really do that. But if you don't have the going concern condition, you probably have to fill some liquidation condition, right? If you feel, okay, the company really is going bankruptcy, all the assets I have valued would be totally different, okay? That will be subject to the liquidation basis. And the accrual basis of accounting, I think last lecture I discussed a little bit. Give you the example as non-current asset again. So that's accrual based, right? If that's not accrual based, we won't do the depreciation expense. We probably will just get all the cost of the whole machine, the whole non-current assets, the cost recognized in current period. But that's accrual basis, which means we need to match the cost expense for the period that the revenue can be generated. The economic benefits can be generated. Then we recognize the cost of the expenses. All right, that's what we do for accrual accounting. That's why also for the revenues, if you just receive some revenue in advance, you probably will not recognize it as the revenue. You will recognize the revenue for the corresponding period that the revenue is really generated. All right. Materiality and aggregation. You know, when we see the financial statements, financial reports, we do see the line items, right? We don't really see they disclose, okay, a computer, a chair, a desk, a lectern. You don't really see items like that. you will see maybe something aggregated together, all right? If they have the similar class of atoms are aggregated, okay? But if there are different classes, and if they are material, they need to be disclosed separately. Like we have non-current assets, we have current assets, right? And we also have liabilities, right? So they have different, we don't simply disclose a figure called equity. That's the net of assets and liability, right? But we will disclose them separately. All right, so that's about the materiality aggregation and also involving the offsetting. So we don't simply offset each other, right? Though in nature they might be able to be offset, but we don't really offset them, okay? However, if something really immaterial, so you probably don't want to disclose each atom. Like for the manufacturer company, they have office furniture, and they may also have some computers. They probably don't need to disclose each of them by their own class. They will just aggregate them together because that classification isn't that important. So they don't need to do that, okay? And offsetting, similarly, so we need to disclose them separately. We don't directly offset them unless we can get the same offset from the same transaction. You might be a little bit confused by that sentence. Think about your tax payment, your tax payable. If you are about to pay some tax, and you will, from previous years, you get some tax reduction. So you have payable, you have reduction, we'll offset them. That's coming from the same transaction. Unless the situation like that coming from same transaction, we don't really offset them. Is this okay? So that's another one. And the frequency of the report, at least in Australia, that's annually. Yes. In some other countries, they may have semi-annually, even quarterly. So in Australia, every reporting entity needs to at least have the annual reports, okay? Some firms might be subject to half year, okay? But they will be specified. And we need to have the feature of comparative information. Comparative information means if you look at the financial reports of any company for last year, 2018, the report, most of the companies have released their reports already. If you look at their reports, and you will find out the information for 2018. You will also find out the information for 2017. For every year's financial reports, they will also have previous year's items just paralleled lined over there, okay? So that you understand the comparison. So that's required. They need to have that previous year's information, so you got a direct comparison. All right, of course, if you need more comparable information, you probably can do some analysis, but that one needs to be presented. That's required, okay? So that's about the comparative information and the consistency of presentation. If you find out a format or the formula to follow to present your statements, your report, we want to make sure they are consistently presented, and also they need to be following the same accounting policy and estimates. Unless things will become more relevant, otherwise you don't simply just change them. We want to make sure, last year I see your profit as 1 million, this year is 5 million. I just want to make sure that's really coming from the same way you produce the figure. Right? If you just simply change some policies or some measurements, then probably the thing would be totally different. The 5 million and 1 million, I can't really compare them, and it's not relevant because you change the two things, the way to prepare them are not consistent. That's why I can't compare them. That's another feature we require. They need to have the consistency. However, if you say, okay, the accounting policy we followed last year, if we still follow the same policy, we really won't get the information very relevant to you. Then you may change your accounting policy. Is that allowed? Yes, but you definitely need to let the users know how do you change and what the effects of that changes. All right? So you can change things, but you need to make sure you believe that information is still very relevant. All right? Or to be compliable with the new standards requirement, you can change things. Or if there's no standards require you to change things, but you think that change, of course, that's still based on the whole requirements allowed, it's still allowed, then you change that, but you will say, okay, I changed this because this information will be more relevant. All right? Okay, I have all the details in the following slides. If you haven't got some information from what I have talked, you can just check information in the more detailed information over here. All right? So, yeah, basically I've talked each of them. Yeah. And the statement of financial position. The statement of financial position. So that's the balance sheet. Sometimes we call them balance sheet. So there is no prescribed format. You think there's no prescribed format, but why? What we have learned, they all have a format to follow, right? It looks like they all follow the same format, right? But yes, this is not specifically prescribed by the standards, but there is a guidance. You can follow the guidance. If you don't want to follow, that's still okay, but you may say the information is more relevant, okay? So, but there is no specific format required from the standards. But for the people's use convenience, most of the company will follow the same format, all right? But if you see something not the same format, that's still fun as long as they consistently stay with that and as long as their format may bring more relevant information or more directly be understandable by the users, all right? But the guidance does give the classification like the current assets, non-current assets. This is based on the normal operating cycles. So that's not prescribed, but there is a guidance for the format. And for the bank, they may just use the liquidity to list their assets. Because for banks, liquidity is more relevant, right? Okay, another quiz. Have a look. Are you able to respond? Still no? According to WLSB 101, a required format, okay, by the way, the number, the code of the standards, I'm not going to test you on that. But if I give some following sentence, you would be able to understand what is required, all right? Because you will see what's that about. But I'm not going to test you to show me the accounting standards numbers at all. A required format for the presentation of statement of financial position is A, not prescribed, that's correct. No guidance is provided, that's not correct, right? Set B, not prescribed but guidance is provided. That's right? So the answer is B. Okay? Let's see, for the statement of profit or loss and other comprehensive income. So yes, you have learned this statement, right? And the comprehensive income has two components. One is called profit and loss. The other one is called OCI, other comprehensive income. Other comprehensive income. So have you heard about this before? Not yet. In this course, you are going to learn this one soon. By saying soon, I mean next lecture. We are going to do revaluation, okay? Then you will see we talk a lot about revaluation surplus, all right? So that would be part of the other comprehensive income, which is not coming from the normal operating business. Okay, it might be coming from some revaluation, impairment, exchange, the exchange rate changes, or remeasuring of some financial assets, or the hedging funds, hedging instruments. So the other actual gains and losses. So those things we will now touch on in this course. But the first one, revaluation surplus, you are going to learn that, all right? So you do know the profit and loss statement will have two components. One is the profit and loss, another is called other comprehensive income, right? Okay, another case. The primary source information about the entity's financial position to be found in is the primary source of information about company's financial position would be found in statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flow. Which one? A or B? There are key understandings of these different statements. Do we know when you report the financial position, when you report the balance sheet or statement of financial position, that's always at a specific date. Do you remember that word? The prep, at, we always need to have the at. For the profit and loss and other comprehensive income statement, we always have the prep for the period, for. You know why? Because financial position is always at a point of time. And the performance is always for a period. If you want to understand the position of the company, that's always at a specific day. That's your primary resources of this position, would be the financial statement of financial position. And financial performance is always for a period. You will see the revenue, the profit for the whole year. What you can see from the financial reports, that's for the whole year or the whole half year. It's never going to be at a specific point because a specific point doesn't matter for your performance, right? So your primary source for financial position absolutely coming from A, the statement of financial position. All right? Do the other statements have a little bit of information on financial position? Yes, they do have some, but that's not a primary source. Okay? That's why we specifically prepare the financial statement of financial position. Okay? Notes to the financial statements, there are a couple of things important for the notes. So the notes always, because the notes would be really helpful for the user to understand what has been calculated, what has been reported, right? They really need to understand that. That's why the notes are needed. And the order of the notes, when you look at the notes can take tens, hundreds pages, okay? Could be happening in that way. So the order of the notes always about the summary of accounting policy and accounting estimates, and they will have supporting information for items in statements. So first, they will always have the summary of the accounting policy estimates. Then each line item in the statement should be cross-referenced. Then you can see that information from the notes. Okay, and they will have other disclosures like the dividends and company's details and the auditor's remuneration. The accounting policy. What are the accounting policies? Accounting policies are basically the principles, the basis or rules adopted by the company when they are preparing and presenting the financial reports. So one standard 108, WLSB 108, is specifically for accounting policies, changes in accounting estimates or measures. Okay? This deals with the setting of accounting policies and any changes in accounting policies and at disclosures concerning those policies. The content of the accounting policy is outlined in the WSB 101. Again, I'm not going to test you, is this content from WSB 108 or 101? Okay, I'm not going to do that, all right? The details may be prescribed by other accounting standards or be a matter of management judgment. Again, you will see, though they are required and compulsory for the outline, but when you are really disclosing that, that could be subjective, all right, based on the management judgment. So the notes, firstly, always need to have something like the financial statements are general purpose financial statements, right? And they will have the, to tell you these statements are prepared in accordance with FRS, WLS, okay? Australian accounting standards. And it also comply with the interpretation. Remember, we talked about the interpretation. It also has the force of law. We have standards, and we also have interpretation. Then we need to have they both have the force of law. All right. So that's about the accounting policies. That's always about the principles, the measurement basis, and the rules the company follows. So some specific accounting policy may be in some specific, like I mentioned, the 108, WSB 108 is discussing the whole policies, right? Accounting policies, estimates, and measures. And this 101 is providing the outline of that. But some standards may have specific requirements for some specific items, like inventory is actually regulated by a separate standard. That's why when you do the accounting policy for inventories, you will check these standards. All right. So when it has these specific standards, you should follow the specific standards. And if there are no such standards, you may have to have the management judgment. This would be for the disclosure of accounting policy. Can you please give me some examples of the accounting policies? What would be the accounting policies, do you think? LIFO, FIFO? Yeah. So first in, first out, or last in, first out, right? But that will be following the inventories, right? Yes. Anything else? That's the principle. So you deal with this class of items always following that way. Okay? That's the accounting policy. How about depreciation? How do you think? Straight line? Is that accounting policy? That's a method, and that's based on your estimation. Why that's based on your estimation? Because you will estimate, how do I use this asset? How many years this asset is going to be used? Am I going to accelerate use this one in the first couple of years, right? Or I will do just every year the same, right? That's regarding your depreciation method. That's actually your estimation of how are you going to use it and how many years useful life they have, right? So that's accounting estimate. However, if I say, shall I do depreciation for this item? That will be accounting policy. Then for the whole class of this item, I will do depreciation for it. Regarding to how do I do depreciation, that's based on my estimation. That's accounting estimate. But shall I do for this class of item? That's accounting policy. Remember, accounting policy is always involving principles, rules, and the measurement basis. If for this type of assets, I always follow historical cost, or I will just follow the market price. Is this accounting policy? The choice between historical cost or the market value, that's the policy. That's the policy, right? Regarding how do I do for the measurement basis, that's the measurement basis. That will be accounting policy, okay? Because it involves principles, rules, measurement basis, then that's accounting policy. But if really based on your estimation, that will be accounting estimate. Why do we care? Is this accounting policy or accounting estimate? Why do we care? First of all, we need to disclose, right? And more importantly, whenever we change something, we also need to disclose. And the changes in accounting policy, changes in accounting estimates have different requirements to disclose, to follow. Okay? Is that clear? Accounting policy, when you change it, you probably will do retrospectively. You will see how much everything has been affected in the past, in the present, in the future. But for accounting estimates, they have different requirements. You only need to do prospective changes. Give me some examples for accounting estimates. What is your estimation, or what is the estimates? Depreciation method I mentioned? Yes. Because you need to estimate the useful life. You need to estimate how are you going to use this asset. Bad debt, very good. So double debt expense, yes, that's based on our estimation, right? So those kind of things are based on the estimation, like long service leave. You always have some estimation over there, okay? Because you don't know whether that's the time to estimate that figure, because you may have 100 employees. They have been working in the company for 20 years already. They are entitled to take some long service leave, which you still pay them, right? But you don't know when it's going to happen. But every year, you probably need to estimate the figure to recognize that, right? So that's based on your estimation. And some other cases, I haven't discussed that. Later on, in lecture 4, we will discuss leases. For leases, for this type of leases contract, shall I deal with it as the financial leases or operating leases? That's, you need to have the consistent policy to follow. That will be your accounting policy, all right? And regarding every year's usage or every year's revenue, that might be based on your estimation, right? But regarding this type of contract, that type of contracts, that should be the principle for you to follow for all these kind of transactions. That will be your accounting policies, all right? Here I also give some examples. Yes, if you have changes in accounting policy, then we don't randomly change them. All right, you either follow accounting standards. The standard require you to change. For example, the leases. Previous years, actually the new leases standards start to be effective from this year. So when you look at the annual reports, the leases content might be different. But if they change the policy per the request of the standards, you still need to disclose the changes and how that may affect the previous figure, present figure, and future figures. So you need to show that, all right? Because consistently, you systematically change something you consistently have followed, all right? So you need to disclose that, and you will show the past effects, but only to the extent practical, because you probably can't go back for 10 years, 20 years, right? So to the extent practical, you need to show the changes, the adjustment. And disclosure of accounting estimates, we've discussed about the estimates. The estimates should disclose the disclosure for estimates should disclose their estimates nature and their carrying amount as at reporting date, the carrying amount of that. And any changes in accounting estimates require prospective application, which means you apply that for current year. If your accounting estimates change, like I have the customer, their solvency has changed, they become insolvent, right? Previous years, I estimate there is a 50% chance because they haven't been paying for the last 2 quarters or 3 quarters, right? So I know they probably will go insolvency, but I'm not 100% sure. So I estimate the bad debt ratio would be 50% from them. I did that estimation, right? And this year, now they become badly, and the signal becomes so strong, I kind of understand 80% we will get nothing back, right? Then you will get new estimation, right? And do you go back to change last year's 50%? No, because you didn't make anything wrong. Your estimation was based on last year's condition. Now the condition changed, you still did everything correct, just need changes, so you change accordingly. And you report that in current year. If the following years, you just follow your new estimation. That's it. Okay? Regarding the depreciation method, that's the same. If you assume this asset is going to have another 10 years useful life, then you follow in that. However, supposedly for the technology involved equipment, so previously you estimate they are going to have another 10 years life. But now, due to the advances in the technologies, you understand it's going to be used for another 3 years only, then you will certainly change your depreciation, right? Then your estimation changed. You don't need to go back to change the previous year's depreciation expense, but for current year, you change for 3 years basis. For next year, you do the 3-year basis for useful lives. Clear? Okay, another quiz, please. Read a little bit. The quizzes we present here are very much, the quizzes you are going to be tested are very much in a similar format as we have seen in class quizzes. All right? The company discovered the estimated useful life made on material depreciable assets was incorrect due to a change in the way the assets was being used. The correct accounting treatment of this event is to disclose the change in the notes to the financial statements, treat it as an error and adjust retrospectively, treat it as a change in the accounting estimate and adjust prospectively. treat it as a change in accounting estimate and adjust. The C is adjust prospectively, D is adjust retrospectively. So the answer should be C. This is the change in accounting estimates, and we adjust prospectively. We don't need to go back to change previous year because that's based on the estimation. That's not really the error, right? Next. Which of the following doesn't involve the use of estimate by an entity in preparing its financial statement? Doesn't involve accounting estimates. Which one? Nobody chose A or B. That's good, because doubtful debt asset, debt expense, depreciation expense, they do involve accounting estimates, right? An original purchase price of an asset, employee benefit liability, such as the long service leave. Which one doesn't involve estimate? Last year, I bought an iPad, which cost me $1,000. Can I estimate a different price? No, the price I purchased is the money I paid. That's just a matter of fact. You can't do any estimation for original purchase price. That's it. You can't change a historical cost, right? That's it. So when the company purchased an asset, that a historical cost, that purchase price, you can't change. You may change the value of the assets in your account later due to some issues, but the historical cost is the historical cost. That's the price you paid. It doesn't change, right? You don't have any estimation for that past paid price, all right? But you do have estimation for, like I said, long service leave. If you believe they are going to take the long service leave, maybe I have 100 people, they are all working here, they have been working here for 20 years, and I may estimate 20% of them for every year may take a long service leave, right? So that's the estimation, all right? So the answer should be, which one doesn't involve C, right? Errors. Sometimes we do make errors. How do we correct them? No matter intentionally or unintentionally, we are human beings, we make errors. If we found errors, we do need to correct them. However, if they are really immaterial, we don't care much, all right? So look at here, if an entity shall correct material prior period errors retrospectively in the first set of financial statement authorized for issue after their discovery, which means if current year I'm preparing for the current year financial reports and I discover last year I made some measures, this year is going to be the first period I discovered the problem. Then I will correct it in this year. All right. And you need to restating the comparative amount for the prior period presented in which the error occurred. Or if the error occurred before the earliest prior period presented, restating the opening balance of the assets for the earliest prior period presented. You might be a little bit confused. 2018 now, I'm preparing. And I discovered some error in 2016. All right. So the first available year is current year. All right. I will also correct the numbers for the beginning balance for 2017. Is that clear? Okay. That's the way we correct the errors. Okay, the earliest. However, if this company decided to disclose every 3 years, which means for current year, they also reported previous 2 years figure. They will go back to 2016. All right, that's what this information about. Another quiz? The correction of a material error that occurred in previous period must be accounted for by A, ignoring it. If that's material, you can't ignore it, right? It's wrong. B, a prospective adjustment to the financial statement. So we do not change the past. When we say prospective, we mean the future, right? So we don't change the past. That's B. C, an adjustment in future accounting period, same, almost equivalent to the prospective way, right? D, a retrospective restatement in the first financial statement issued after the discovery of the error. So the answer should be D. All right. Okay, materiality. So we discussed the error. If that's immaterial, we don't care much. If that's material, we must correct something, right? So material always something we need to consider. So immaterial errors may not be corrected, or immaterial facts may not be reported. That's what we do for this. So because we think if they are immaterial, then they are not going to affect your decisions, right? So that's okay. We are fine with that. How do we identify the materiality? It's kind of a little subjective, right? How do I define it as material? If its omission or misstatement could affect the user's economic decision, that will be immaterial. If it's not going to affect your economic decision, that's immaterial. It still seems like a little bit vague, right? How do I say that's going to affect your economic decision? Right? It's hard to say. Yes, we do have some space to make judgment by ourselves. All right? And it requires a judgment. So both the nature of this transaction or the size of this transaction both matter. When I say the nature, the size, in previous materiality standards, they did give some guidance on the size, the amount of the error, how big that is, we need to correct. Because that big we believe that will be material, then we need to correct. This is what the previous standard said. But now this guidance is erased because regarding the size, it's still difficult to say whether that's immaterial or immaterial. Okay? Beyond the size you need to consider, you also need to consider the nature. Like at the beginning of the lecture, did I say something, no matter how big, how important that is, you need to disclose for something? What did I say for that thing? Related party? Yeah, they are important in nature. No matter how big or small, you need to disclose. No matter how big or small the errors you make, you need to disclose. All right? So that's the materiality. So you judge them on two things, nature and size. Previous standards gave some size, like if they're 10% or 5% or something, but now it's not applicable because you can't really just say that by size. Okay? So this one is not in standard anymore. Okay, another quiz, please. Which of the following statement is correct? Extensive guidance is given on the concept of materiality? No, they don't. Disclosure provision of accounting standards must always be applied, even the resulting is immaterial. If it's immaterial, we don't care much. Materiality only ever depend on the size? No. Both size and nature matter. Okay? The disclosure provision of accounting standard do not need to be applied if resulting information is immaterial. Yes. So the answer should be D. All right. Okay, here we are discussing two things. Events occurring after reporting period. And next one, we are discussing related party transactions. All right. You will find that interesting, fascinating, and also a little bit confusing. Let's see. So WSB 110 is discussing the events after reporting period. So like I said, reporting period, we always have something here. So this is the 1st January, and this is the 31st December, suppose so. Or some firms may start from the 1st day of June until the end of the May. That's fine, all right? So that's their own financial year. They can define that, okay? So suppose they start from this year, and you will prepare statement for this period, 1 year, annual report, right? After you prepare, you need to get your directors make the director declaration. You will have auditor to have their auditor reports, and eventually you decide on this day. Let's say that's the 31st of March. You can issue them. All right, suppose you receive the declaration and now you can issue them. So now for this period, we actually are preparing the financial statement, financial reports for the whole year, right? However, there is a period, during this period for the 3 months, something happened. And that thing happened, that's important as well, because it's going to affect decision makers' decisions. Let's say I'm a farm, and there is a flood during this period. Okay, there's a flood. And what happened in this period, I have prepared. I've got my restatements. I only prepare for that period. But now it happens after the reporting period. But before, everything can be issued. What shall I do? Right? There's flood for a farm. That's so serious. I need to do something. Okay? How do I do that? 2 ways. One is called adjusting events. One is called non-adjusting events. So you need to make judgment on whether that is adjusting event or non-adjusting event. All right? So however, if let's say, okay, during the reporting period, I have cattle, let's say I have 1,000 cows, okay? But during this period, 1 dead. It's okay, right? I will just record my stock lost 1 for the following period, for the new year's financial statement. But I won't do any adjusting things. I won't disclose, okay, 1 cow dead. Okay, that's immaterial. So whatever we do, based on the materiality, whether or not they are important. If so, I disclose flood, natural disaster, yes, right? So I will disclose. Otherwise, I may, some IT company, they have a summit in some places, and all the major, the key persons from this IT company flew with 1 flight, and that flight got problem. Okay, then none of them came back. Is that serious? Of course, because that's the intelligence. They have the intelligence. That's the human resources that the IT company relies the most on, right? So you will certainly need to do something. What shall we do, right? For those cases, like the IT cases, the human resources cases, I never have foreseen that for this period. For the reporting period, I have never foreseen that. So I haven't estimated anything for that loss. Then I will disclose in my notes. to say something really bad happened to the company, it will affect our strategy and operation in the future. So that's non-adjusting events. That's called non-adjusting events. If, let's say the farmer's cases, suppose, only suppose, they are very wise. During the period, they have understand from the forecast, the whole Australia is going to suffer a significant drought in the past 50 years history. I have already estimated the potential loss during this period because I have foreseen that. I have some estimates. Then probably what I do, I need to adjust those estimates. Okay? If I adjust those estimates, that's called adjusting events. Okay? Or for the company, if I have, let's say, if I have already experienced the flood or the drought during the year, I have already estimated my loss might be 50 million. However, the sequential events shows that my estimation wasn't that right because some new events occurring, some following events. Let's say earthquake. Okay, if I got earthquake now, then there are following earthquake. So I have already estimated something, but that estimation needs to be adjusted. That will be the adjusted events. Okay, so we have two ways to deal with the material events occurring after reporting period. One is called adjusting, one is called non-adjusting. All right, let's have some cases, see what is that. So adjusting events are those provide more information about conditions that existed at the end of the reporting period. For example, so you have a lawsuit during the reporting period. During the reporting period, there is a lawsuit filed, but you don't know whether you are going to win or you're going to lose. But now, before your report has been issued, you know this one is settled. You know how much liability you are going to have. So this is going to be adjusted. Okay, so that's called adjusting events. And if after the end of the period there is an indication that the entity is no longer a going concern, so you also need to change retrospectively because everything you have prepared is for the reporting period based on going concern. Now it's liquidation based, so you need to change that. This is also adjusting. So for all the adjusting events, if sometimes you feel it's difficult to make adjustment, to make judgment on whether that's adjusting or non-adjusting, think about whether or not it involves an amount, involves some balances, involves reclassifying an item, or involves a change in the disclosure, which means you have already done something. Then you need to adjust something. Is that clear? So this is for adjusting events. And for some others, that's called non-adjusting. Non-adjusting are the events after the reporting period. They are materials and that are not related to your existing condition for your reporting period. That's not related. And you have nothing to adjust. But that's still important, so you need to disclose, and you just need to disclose in the notes. That's it. All right. So for example, there is a flood which destroys the company's manufacture plant after the reporting period. It's unpredicted, and you haven't done any estimation, so that will be just the thing you disclose in your notes. You don't need to adjust any balance, any amount, any classify the items. You don't need to reclassifying the items. So that's it. All right. Yeah, so you just disclose them in the notes. That's it. Okay, let's have a quick check. See if you can get them right. Are you okay with seeing that? Okay. So which of the following are adjusting events? A decline in market value of investments between reporting period and the date financial reporting is authorized to issue. Bonus payments that are part of an existing agreement with employees determined at the end of the reporting period. Land Co. Limited is being sued over damage to farmland as a result of an accident in which poisonous chemicals were mixed with fertilizer. The first one. Is the first one adjusting? A decline in market value of investment happened. It was worth of 50 million, now is around 25. Shall we adjust anything? What do you think? That is not an adjusting because you didn't estimate anything. Okay? Of course, you may think about the value change. It affects your accounting information, but it didn't affect your estimation. There was no existing situations related to the newly occurring event. You need to have some existing situation, then you adjust something, right? So there was no such situation, so you don't need to do the adjustment. All right. Bonus payment that are part of the existing agreement now determined. This one is because for the bonus, you estimate for this year your bonus would be how much, right? Because you know that. But one is finally determined, so you must have estimated some figure for that. So now is finally determined. Then that's the adjusting event. You can got a clearer picture for previously existed situation. All right. So Land Co. is being sued over damage to farmland as a result of an accident in which poisonous chemicals were mixed. So they know, you notice the pattern, the past pattern? The poisonous chemicals were mixed with fertilizer. So that was an existing situation. Now they just got sued. You got new estimation. All right? So this is adjusting. Then B and C are adjusting. The answer should be B and C, right? E, this one, right? Okay. 1, 2, 3, 4, 5. Oh, sorry. B and C. Okay, I wouldn't say that too confusing. Or B and C are correct. Let's look at the next. Are you still able to see that? If not, I can move to this one so you can see from. So here I just got the bigger picture for you because the quiz you wouldn't see from your slides. Now you got, if you want to review, you can just review the examples from the following slides, okay? So have a look at this one, okay? So Yarden Lab Limited has series of outback cattle stations. Subsequent to end of the reporting period, it's discovered that the flooding before this date has destroyed several farm buildings, blah, blah. Adjusting, non-adjusting. Before existing situation, now you got more discovery, that's adjusting, very good. And this company has been negotiating a merger with a company that is currently its major supplier. Subsequent to end of reporting period, the merger agreement is finalized. Adjusting, non-adjusting. Adjusting? because you think a merger has been discussed, right? But no, that's non-adjusting. Okay, I'd better let you know the answer first. Why non-adjusting? Remember what you have disclosed, what you have recognized. You recognize nothing when you were in discussion of the merger, right? Because during the merger, you could have 10 other bidders, or right? So if so, you probably never estimated anything. Then you have nothing to adjust. So this is not adjusting, okay? This company has become aware after the end of the reporting period, a major customer is insolvent. The customer apparently went into receivership before the end of the period and owes them a lot of money. Is this adjusting, not adjusting? Adjusting. You must have estimated some bad debt, right? So now it becomes, yes, clear. All of them is going to be bad debt. All right. Okay, another issue, related party disclosure. After this, you will be free, okay? So, yes, your attention, please. Related party is what? Related party could be, okay, okay, first of all, I would like you to know what I'm talking is, oh, sorry, I'm back. Okay. So, a reporting entity, what we are discussing, shall this reporting entity disclose this related party transaction? So it's always relative to entity, an reporting entity. Clear? So remember that. And who can be related parties? It could be an individual or another entity. So if you are the controlling shareholder of another company, then that company as a reporting entity should disclose the transaction with you. So you could be an individual or a company, all right, to be a related party to another company, all right? So for disclosure, that could, for the procedure, you need to consider several things. First of all, identifying relationship and transactions. Then identifying how much you should do, right? Then identifying the circumstances and determine the disclosure to be made. There are 4 steps to follow. Our main focus here in today's lecture is about the relationship. How do we identify related party disclosure? If you read the text over here, they are confusing. You will absolutely get lost. But I will draw a picture for you, then you compare that picture with this text. All right, you will get a clearer idea, okay? This part is discussing the individual, how this individual can become related party to another company, right? And this part is discussing an entity. So how this entity becomes related party to another entity, okay? So these 2 parts. Okay, let's draw a picture over here. Don't laugh at my drawing, okay? This is the individual. This is an entity. So, and this is another entity. So for this entity, this reporting entity, its related party could be an individual, could be another entity. Is that okay? We'll discuss the individual first. There are 3 ways this individual could become related party to this company. One way, this person is controlling or joint controlling, okay, this company. Then that will be the related party. If this person have significant influence, that's the related party. If this person has been the key management personnel of this company. What do we mean key management personnel? Executives, CEO, CFO, COO, CIO, whatever, right? Or this is coming from this company's parents. So if this company E, reporting entity, has a parent, and this individual is the parent's key management personnel, that's also related party. The transaction between them need to be disclosed. Clear? For individual, 3 ways. And also, if this individual has another close family members, they are deemed as this person. in which I mean if this person's no, it's not lost. Okay, good. So like this person's wife is controlling the company, then this person is going to be the related party. Or this person is controlling this company and his wife has the transaction with this company, his wife is a related party. So you deem the close family member as this person. Okay? So that's it. So who are close family member? Wife, children, partner. In Australia, it's also recognized as partner. Then all the partners, children, they are close family members. Clear? That's from individual. All right. And from company's perspective, I shouldn't move. Okay, come back. Okay, for this company A, it could be related to E in multiple ways. That's a little bit confusing, but I will show you clearly here. All right, pay your attention to me now. Okay, so this company could be related party to this company because this company is the joint venture or associate of this company. Don't ask me what is the joint venture, what is an associate at this stage. I'm not going to answer that because you are going to learn later for associate. Anyway, you have investment in that, that's the associate. Joint venture 50-50%. Okay? So anyway, so if this company is joint venture or associate of E, that's the related party. All right? If both of them coming from a group, this is a group. What do I mean group? Don't ask. Because, yeah, you only need to make judgment if they are group member of one group. Yes, that's it. We are going to learn that in consolidation. Okay, subsidiary parents, that's a group. Okay, if they are from group, yes, they are related party. All right. Or they can be connected from a third party. So here is a third party. Another company maybe. All right. So how can they become connected? A related party, related party. This third party may have joint venture for both of them. Joint venture. So A and E are both the joint ventures of third party. So basically this third party has influence on them, right? So they will be related party. Or in one part it has joint venture, another part has associate. So the joint venture for E and associate for A, then these two are also related. A and E are also related. Okay? And also, if this E and A, one of them is running the post-employment benefit plan for another, that's also bringing these two related party. Okay? So that's it. And another way, from entity, that's still relatively easy. Another way is a little bit annoying. Let's see what is that. So we do have this individual, right? We have this individual over here. You see that, right? If this individual have directly influence from these ways to company E, we know that's related, right? However, if that company has some relationship with A, is A going to be E's related party? That would be a question. Interesting. Okay? All right. If A is controlling or joint control A, then A and E, and also has another three types of the relation with E, then that is the related party. A and E are related party. Now it's not that individual and E, that's A and E. They are related party. Okay? However, if this individual only has